Welcome to MBS Highway's forecast for 2022. I'm Barry Habib, and I'm so excited to bring this to you. We've put a lot of work into this. Our whole team has really done the best we could to look into that crystal ball and see what's ahead. We want to take a look at what's ahead for housing and what other factors there could be that can contribute to performance in housing. The same for interest rates, and even look at the stock market and the things that are going to play a major role in 2022. So I'd like to get started. I've got some slides here to share with you. So we're going to work with that so you could follow along. But before we go into 2022, let's take a look back and see how did we do with our 2021 forecast. So we, in 2021, as we recap this, we did make a forecast for interest rates that we thought they'd rise in the beginning of the year, and then they'd recover. They'd fall back as we headed into the fall months. And, we did pretty good on that one. They did rise sharply through March, and then as the year went on, they did come back. Interest rates did recover and come down, but they did so a little earlier than we thought. We thought it would be in the fall, late summer. They started to come back down. So we did pretty good on that forecast, as well as the contributing factors to this. And then housing, we had a pretty bullish forecast for housing. We thought that demand would be very strong, supply would be very tight, and as a result, it would push home prices up, except that we forecasted it to be up in the high single digits. The problem was that, man, housing actually went up a lot more than that. Went up double our expectations. Now, there were a lot of people that forecasted that housing would either be down or flat or struggle. So at least we were on the right side of this one and thinking they'd be up in a pretty robust way. But in actuality, it was much stronger than even we had anticipated. So housing was a stellar performer in 2021. Now in 2022, what are the things that are going to play a role here? So the Fed is going to be a major player. Probably the largest role in the financial markets that the Fed has been playing in a long time. And they have played a major role already. But this year, they're going to be very active in ways that they haven't done so, like tapering their purchase of mortgage-backed securities, which they've done so already, and hiking rates, which looks very likely for 2022. And then the other thing that's really a wild card is the balance sheet that they have. Will they allow mortgage-backed securities to run off because they've been reinvesting? And also we want to take a look at the equity markets, the stock market, and what's going to drive interest rates, because the Fed is going to have an impact on both of those, and the job market and housing too. Now, the Fed has 19 members, and 12 of those 19 members vote, so they rotate. The 2022 composition is going to be a little less accommodative than the ones that were voting in 2021. So they may be more in favor of tightening bias than the voting members in 2021. Fighting inflation is going to be a big deal. That's going to be their main focus. And if the stock market doesn't like the Fed's actions, in the past they haven't had the backbone to continue. So they could lose their resolve here. Now, we know the Fed should have hiked sooner. They thought inflation was transitory, right? But I want to look at some history with you here because I find this very interesting. And I think that if we look at history, it'll help us. Let's go way back to the 70s. And this guy that you see here, he looks kind of smug, doesn't he? That's Arthur Burns. He was the Fed chair back in the 70s. And this guy was the Fed chair when inflation was rising rapidly. In fact, it went from 7% to 14%. Look, 7% is already high inflation. But it went from 7 to 14% inflation. Now, for many of you in your entire mortgage career, you haven't seen inflation more than 2 or 3%. Could you imagine 14% inflation? Well, he thought it was transitory. Does that word sound familiar? How many times have you heard Jay Powell say transitory, right? So he was steadfast that transient inflation, it would pass. But this higher inflation that he allowed to happen caused mortgage rates to move up. And mortgage rates were at 12%. It was considered to be a good rate back then, right? Isn't it funny when a client tells you, oh my gosh, 3.25%, that's high. Well, 12% was considered to be pretty good. But in a short period of time, mortgage rates went from 12 to 18%. And that was all under Arthur Burns, who allowed inflation to run hot, and inflation caused mortgage rates to rise. Why? Because remember that interest rates hate inflation, because if you're loaning money, if you're the person lending it, the money you're receiving, typically a fixed amount of money you're receiving every month. If inflation is going up, that means that money that you're receiving buys less and less and less over time. So the only way you could protect yourself is to increase the rates you get on future loans to offset the lack of buying power that you're getting because of inflation. Now, in 1980, Paul Volcker, and I did spend some time with Paul Volcker, amazing guy, what a strong person. He wanted to fight inflation. He hiked the Fed funds rate from 11%. Now, again, this is something pretty incredible. It's been near zero for a long time, right? Could you imagine already at 11%? But he took it from 11 to 20 in order to fight inflation. That made interest rates high. It made money very, very tight. But he was successful. He did kill inflation. It dropped from 14% under Burns to under 5%, much more manageable. And because inflation dropped, well, mortgage rates, they declined pretty sharply. They went from that high level of 18 back towards 12, which again looked pretty good back then, but there were consequences, you see. The stock market, it declined by 30%. Did not like the Fed's tight policy. And it also pushed the United States into a recession because things slowed down. Money becomes tight. People don't borrow as much because it's more expensive. We don't see the economy grow, and we go into a recession. Now let's go to Alan Greenspan's tenure. And in the late 90s, Alan Greenspan saw inflation double. It went from 1.75 to 3.5%. And that higher inflation caused mortgage rates to rise. It rose from 7% on mortgage rates for a 30-year fixed to about 8.5%. Now, but Alan Greenspan, he was different than Arthur Burns. What he did was he wanted to take action. He wanted to learn the lessons that happened in the 70s, in the late 70s. He didn't want to have a situation like we saw with Paul Volcker, where we had to take dramatic action. So in mid-1999, he hiked the Fed funds rate by that same 1.75% that inflation went up over time. He caused interest rates to rise from 4.75 on the Fed funds rate to 6.5% within a year. And as a result, what had happened? We saw inflation respond and drop from 3.5% back towards 1%. So by increasing the Fed funds rate, he was very successful in killing inflation, much like Paul Volcker. But because he acted quickly, we didn't have to take dramatic action. Now, mortgage rates dropped from 8.5% on the 30-year fix all the way down to 5.5%, and that did spark a huge refinance boom. But just like under Volcker, when he hiked rates, there were consequences. This time, the stock market was already expensive, and it fell 50%, cut in half in just 6 months. That was awfully painful. And once again, the U.S. entered into a recession because the tighter monetary policy, things slowed down. Now today, under Jerome Powell, and again, this is a gentleman I did get a chance to spend some time with, in 2021, inflation increased from 1.75 to 7%, a dramatic rise. And he let it run hot because he thought it was transitory, kind of just like Arthur Burns. Now that higher inflation caused mortgage rates to rise from 2.5% to about 3.375%. It didn't jump that much. Why? Because the Fed was very active in its purchases of mortgage-backed securities, so that helped put a lid on it. But even with the Fed buying in new purchases, $40 billion a month, in reinvestments, $70 billion a month. So think about that, $110 billion a month in mortgage bond purchases. We still saw a pretty big rise in mortgage rates from 2.5% to 3.375%. Could you imagine if the Fed wasn't buying, what mortgage rates could have gone to? Perhaps into the 4s or even 5% range. Now, the Fed is currently slowing down their purchase of mortgage-backed securities. They started doing that. And they're not going to try and do two things at once. So they're not going to taper and hike rates at the same time. But they should be done tapering in March. And they're likely to begin hiking at their first Fed meeting after the tapering's done, which is May. Now, that could change depending on economic conditions, but that seems like a reasonable target to expect the Fed to start hiking rates. They're targeting 3 rate hikes in 2022, more in 2023. But again, they'll have to monitor things. And also they're going to be sensitive to how the stock market reacts. Now, inflation and interest rates can still rise until the Fed starts hiking rates. So get this, we're going to be seeing still a lot of inflation, at least through February. Mortgage rates probably won't like that very much. And the Fed's still going to be buying mortgage-backed securities, but they're going to be buying less of them. So that suggests that we could see an increase in interest rates through the first few months of the year. But if the Fed is successful later in this year in taming inflation, mortgage rates should drop. But they could be from a little bit higher levels. Now, I want to see if you see a pattern here. Let's compare. So Burns and Volcker, they did see inflation go up quite a bit, as did Greenspan and also Jerome Powell. So mortgage rates rose under all three as inflation rose. The Fed funds rate, to help stop this, Paul Volcker took it from 11 to 20, Alan Greenspan from 4.75 to 6.5. Now in 2022, the forecast is for the Fed to take the Fed funds rate from 0 to 1. Now the response in inflation was for inflation to drop. Again, inflation dropped. So it should drop in 2022. And the mortgage rate response was favorable. As you can see, big drop, big drop. Mortgage rates should decline as inflation declines, but the Fed has to start hiking rates first for us to see that, and the consequences are, as you can see, the S&P was down, the stock market was down a lot, and a recession. Big drop and a recession. Stocks are expensive right now, and the economy could be slowing. If the Fed starts tightening, stocks could be in for a little bit of a tough time. Could we be headed for a recession maybe in 2023? Well, we think that that's a reasonable possibility. There are some wild cards, COVID, for goodness sakes. We know what's happening here, and that could cause changes in the supply chain, and the additional stimulus that may be out there that that Congress may pass could fan the flames of inflation, because stimulus could be something that, if there's a new bill that comes out there, it could be something that creates more inflation. That's going to make the Fed's job more difficult, and the runoff of the Fed's balance sheet is going to be a big one, because first step, we're seeing that. We're seeing the Fed slow, and then we'll stop their purchases of mortgage-backed securities and treasuries. Then the next step will be hiking. And then do they stop their reinvestments? That's the big one. Because if they do that, that could cause some rocky times for mortgage bonds. That may happen in 2022 or maybe a 2023 event. We're going to have to keep our eyes on this one. This is a big wild card, probably the biggest one. Stock market we talked about. Pretty much by every measure, the stock market is about as expensive as you can imagine. Pretty much by every metrics, the stock market is a very expensive one right now. Price to earning multiples are high. If the Fed starts hiking, the multiples that are out there on price to earnings ratio could contract, and that means stock prices could drop. So our forecast for this year is for a 10% drop in the major indices in 2022. Could be more than that. But based upon what we're seeing and based upon the history we've shown you, we believe that that's a reasonable forecast. Now, how about interest rates, though? We think that interest rates do rise along with inflation the first part of the year. They could move up towards a range of between 3.5 and 3.75 is a reasonable range as inflation continues to be persistent, at least through February, maybe March. But maybe as it starts to come down in the spring months or into the summer, we could see it head back down, especially if the Fed takes action. And if we get a softer stock market and slowing economic conditions, they should head lower in the second half of the year, probably towards 3%. Our forecast is rates rise in the range, 3.5, 3.75 for the first half of the year, and then decline towards 3% in the second half as the Fed starts hiking rates. I know it's counterintuitive. Fed's hiking rates and mortgage rates come down. Yeah, we've seen that in the past, and we've shown that to you, because as the Fed corrals inflation, mortgage rates like that. So this strategically sets up a bias for less upfront fees, less expensive MI. Let's have a mindset towards lower cost, because we think there's a refi opportunity ahead. Now, housing, well, housing's going to remain strong in 2022, but not as strong as 2021. Demand's going to be slightly softer because interest rates will be a little bit higher, but it's still going to be robust. Now, supply will eventually start to increase, but remain tight. Let's remember that the labor shortages, the supply chain disruptions, semiconductors, every house that comes on the market, it's got computer chips in it, because your washer, dryer, your refrigerator, your appliances, everything that goes into us, and computer chips are a major role. Most of them come out of Taiwan, and because of the supply chain disruptions, this has been a challenge. So as this eases up, and it will, we're going to get this figured out. More homes come on the market, that loosens up supply a little bit, and while housing is expected to remain tight, maybe just not as tight as we've seen. So rents, on the other hand, they're going to continue to rise. Increases are going to remain above 5%, maybe way above 5%, as you've seen. And that's going to push people, perhaps, to see the benefit in home buying. So overall, what do we see? Mid to high single-digit appreciation in real estate, still providing a great wealth creation opportunity. We hope you've enjoyed this forecast. It's really been heavily focused on the Fed in comparisons, but we believe that the Fed is going to play a major role this year in the way things go. Most importantly, we wish you a wonderful 2022 with a lot of happiness and health for you and your family, and a lot of laughter along the way. please make sure that you do all you can to enjoy it. Bye-bye.